Welcome back, everyone, to the Risk Intel podcast, powered by SRA, where we share risk intelligence from experts across the banking industry. I'm your host, Ed Vincent, Executive Vice President at SRA. Hello, welcome back to today's Risk Intel podcast. Please join me in welcoming Amitabh Bhargava. Amitabh has a distinguished career in the risk space, which includes working as a commercial underwriter at ICICI Bank, followed by 18 years at Capital One, where he oversaw credit analytics and research for Capital One's consumer and wholesale portfolio, and supervised executive credit risk assessment and portfolio modeling for both Capital One's wholesale and retail portfolios. Now, as head of the credit portfolio management practice within SRA's credit consulting team, Amitabh advises in a number of areas, including how to identify forward-looking indicators using economic, sectoral, and competitive analytical frameworks. Welcome, Amitabh.
Thanks, Ed.
Your current area of focus on forward-looking indicators is the topic of today's conversation. So let's start by digging into the state of consumer lending and specifically drilling down into the credit prospects for auto lending. So what behavior and trends are you seeing in the consumer lending space today?
Absolutely. As all of us know, and I would say as Fed keeps on seeing that in spite of all the rate rises they are doing, consumer still is holding strong. And if you look at consumer, we look at multiple metrics. How are they spending? How's the employment doing? How's the incomes and wages? How's the wealth? What kind of debt they're carrying? And what's their confidence and sentiment that they have? If you look at all these things, the spending still continues to be pretty good. And partly because employment is in fairly good shape. The unemployment rate is almost near a 50-year low. Incomes are fairly strong because employment market is fairly strong. And the wealth indicators are pretty good because the stock market is doing okay. The home prices, they haven't buckled. And more importantly, the excess savings that folks have, because during the COVID times, there was so much fiscal distributions to consumers. They didn't get to spend it a lot because you couldn't step out of your house. So all of that was sitting on their bank balance sheet. And that's been spent down, but it's still a sizable amount is still there. Primarily, now, if we break it out by different income cohorts, then one would say that maybe the top 20%, top quintile, that's holding most of those excess savings. The bottom 80% has almost spent it out. And that's why we are seeing somewhat of a dichotomy in credit performance in consumer credit, that in subprime area, we've started seeing some buckling, whereas the prime, super prime area continues to be fairly strong.
So if you drill down from there, right, that's the consumer landscape broadly. There are subcomponents of that or components of that. Take us through what some of the larger components are there. I know auto lending is a particular area that you've spent some time focusing.
If we think about the entire consumer lending in US, it's nearly a $16 trillion market, a big number, right? So, and about 3/4 of it, 75% of it is unsurprisingly mortgages and HELOCs. So mostly, housing related kind of lending. 1/4 of it is non-mortgage lending, which is split about 35 in between the student lending and auto lending. And the rest of it, a substantial part, is credit card lending. So auto lending is a big component out there. As most of us are aware, in student lending, there have been a lot of forgiveness, forbearance of interest, and so on. So the metrics that we see in student lending, they're not truly reflective of credit quality out there, but we are definitely seeing some rise in delinquency rates, roll rates in the auto finance market over last 12 months or so. So that's what we are gonna dig a little bit more into.
Okay, so let's unpack that then. Let's go a little bit deeper, right? You've given us the the breadth of that consumer landscape. Let's get into that auto space in particular and understand what the implications are for the for the trends within that auto space.
Yeah, so if we look at the auto lending market, it's obviously driven by what's happening in availability of autos.
Yep.
And in terms of, if you look at the supply demand scenario for automobiles since COVID, there have been a lot of disruptions which have occurred. Obviously, during COVID, there was trade had suffered. So a lot of components, because auto market is one where the supply chains extend all across the globe. And it did impact that, more importantly, in the area of chips. And because of lack of those semiconductor chips availability, the entire supply of new vehicles, it's not yet recovered fully.
It's incredible how those chips, you're not aware of it, but they really control everything in the vehicle, right? So it shuts down the entire.
Yeah, we
process.
were talking on, we are recording ourselves on this, video camera or use our smartphones. So frankly, those chips are driving the world right now.
Yeah.
And some estimates say that because of the toned down production, the globally about 10 million less vehicles were produced during COVID times. Now they are catching up, but still the production is not back to pre-COVID level. And that is impacting a lot of things out there, because when there aren't enough vehicles being sold as new vehicles, there is a lack of availability of used vehicles a few years down the line, because all the Avis and Hertz car rental companies, they're not selling those vehicles as they would typically.
And those vehicles coming off lease, there's fewer of that. Maybe people are holding on to them, right?
Yeah. So that is causing prices to rise. And that in conjunction with higher interest rates, which are triggered by Fed policy, obviously that's going to have a big impact on affordability of those vehicles by people. So that, how is that being mitigated? That's being mitigated by all the lenders by further stretching out the terms of auto loans.
Okay.
It used to be in olden times, 3 to 5 years. It became 5 to 7 years, and now 7 years seems to be the norm. So the average term of a new auto loan or even a used auto loan is almost between 66 to 70 months now. As we know that the longer the term of credit, the more the uncertainty around it, because you don't know what happens to the consumer and the conditions that they would face over the next 5 years, 6 years time period. And that elevates the risk for lenders quite a bit. So that's one piece of the puzzle, but also there are so much structural changes happening in overall automobile market. As you would know, the EVs are the big norm, and I guess Tesla's Model Y, last I read, was one of the highest selling vehicle these days. How is it sold? It's sold directly from Tesla, the manufacturer, to the buyer. There is no dealer intermediating the thing. Whereas the conventional auto finance market, it's dominated by indirect auto lending, which means selling through the dealer.
Yeah.
So there are, and most of the banks and credit unions in US, they operate through that indirect auto lending market because they don't have the wherewithal to do direct lending as large banks like Chase or Capital One, etc. would do. So the indirect auto lending market overall is facing another structural change.
Serious disruptor there.
Serious disruptor out there. And that gets us also into, while we are talking about EVs, the big thing is about residual car value, because if you, God forbid, the borrower doesn't pay you, you got to repossess the vehicle, and you sell it in the used car market. There is a long-term kind of data on how internal combustion engine vehicles, their values depreciation works over a period of time, there is very little known about EVs.
Yeah.
So that also, is an additional source of uncertainty for lenders in this market.
So with that uncertainty, right, duration, disruption, lack of historical data, how do the lenders then react, and how do they respond in a situation like this?
I guess the best thing to do would be in current environment when they are seeing that the credit quality, which has been very stable practically since 2008, and that's buckling, it would behoove them to do the stress testing of their portfolio. I would say what is really required is a proper risk assessment, and a risk assessment exercise which spans multiple types of risks, be it strategic risk, interest rate liquidity risk, credit risk, ESG risk, which is increasingly important, compliance risk. And that is where SRA Watchtower could be a really useful tool, where there are libraries of various risks and risk indicators, KRIs, KPIs out there. And one could use a very systematic format rather than reinventing the wheel ab initio at their end.
Right. That bottoms up, loan by loan, analysis of the portfolio, and then the top down look at risk, across the organization.
Exactly. As I mentioned, a big component is strategic risk, because we talked about all these big structural changes which are occurring. And in order to, because you may book loans right now, one of the things with auto loans is these are fixed rate loans. You are booking those loans at a particular rate right now. And when the interest rate environment was low interest rates, as we've had for a long time, it didn't necessarily matter what kind of FTP practice various banks, credit unions had. Now, what kind of liquidity risk, interest rate risk management they have, that also becomes relatively important. So having access to, in a way, what are the various sources of risk that could impact your portfolio, and then using all those KRIs, KPIs to, conduct a proper stress test or scenario analysis of your portfolio to wrap your heads around how much the losses or provisions could rise in a worst case scenario, and maybe collaborate with, think about what are the action steps one could take. You could potentially, lay off the risk, sell part of the portfolio, change your underwriting standards, or collaborate with other players in the market. So I think it is the right time for a lot of banks and credit unions to take mitigating steps and look into their auto portfolios.
Amitabh, fascinating. We appreciate the data-driven aspect of this conversation and really turning, the eyes from hindsight to insight to foresight and looking forward here, right? These indicators, in particular in the auto lending space, clearly, portend some difficult times ahead, or at least some different times ahead. And so being able to understand the sources of risk, looking at those different scenarios and coming up with mitigation strategies are great guidance. So thank you very much for those thoughts today.
Thank you, Ed. Yeah.